Here's my picture. All right, and yes, I actually do look like that, except my hair is a little bit grayer. You can reach me at that email address. That's my office email address, and you can call the office and ask for me. And I do check my office email and my regularly and my office voicemail fairly regularly. I will warn you that my beautiful wife and I are going to be down in the Caribbean next week, and I'm going to obviously have very, very limited access. But if you have questions, you can probably reach me today or tomorrow, or just wait, and I'll be back in about a week, and we can talk about anything that you have as questions about this. Now, those of you that know me know that I have a rule, or guideline or whatever, that basically says that I believe that as a presenter or a moderator, it is inappropriate for me to make political comments, especially about things that are as politically charged as what we're going to be talking about today. Now, we're obviously in a webinar situation. We're not in an open situation. You can type in any questions that you have. If they're overly political, I may not read them or answer them, but you can feel free to be as political if you want to vent if you want, or ask any questions you want. You can type them in, and I will see them on my screen, and I'll do my best to answer them. Long ago, it seems like long ago, 40 years ago, when I was with Coopers & Lybrand, and I had a mentor, an outstanding mentor, and his favorite comment was, "Don't let the tax tail wag the economic dog." And I've been using this screen in most of the presentations that I've been doing for the last year or so, because I think it's very, very important that we understand, even though this is not necessarily a tax situation, it is something that is a business situation. And we really have to take a look, and take a long, hard look, at what you're going to be doing in 2014 and 13 to decide what to do with regard to Obamacare or PCACA or whatever you choose to call it. And you have to take a look at the entire economic transaction. This is a business transaction. It is a major business transaction for a lot of people. It is going to affect a lot of people very, very significantly. So you really have to sit down and make sure that you think it through. Make sure you contact all of the appropriate advisors. Make sure you talk to your accountant. Make sure you talk to especially your insurance providers and several insurance providers to make sure that you're getting the best deal and the best advice as to what is out there, because there's a lot of ramifications that you can do, some of which we'll talk about, some of which we won't. But there's a lot that you can do in this area. There's a lot that you have to understand. This is an incredibly, incredibly complicated situation. We're just going to basically give a 25-cent tour of it. If you have other questions, feel free to, once again, call me or email me, and I will do the best I can to try and answer your questions. My intent here is not to talk about the individual mandate, but there is one thing that I want people to understand about the individual mandate, and that is that basically an individual who makes up to 400% or 4 times the federal poverty level can receive assistance from the federal government in paying for their health insurance if it is not provided in an affordable, qualified way by their employer. In some situations, it is actually going to be more beneficial for your employees to receive premium assistance than it is for you to provide them health insurance, depending upon how much you pay. Now, if you're wondering, for a family of 4, the 400 times the premium the federal poverty level is about $92,000 or $93,000 the last time I looked. So we're really not talking about truly low-income people that can receive premium assistance here. When you start talking about people that are making in excess of $90,000 for a family of 4, I don't know, everybody has a different definition of what it construes middle income, but I would say that constitutes middle income, and they would qualify for assistance. What we really want to talk about is the concept of the shared responsibility for the employer, right? And I want to make something very, very clear here. Those of you that have been following this know that for whatever reason, the IRS and the Department of Labor, who basically are going to be issuing the vast majority of regulations in this area, didn't do a whole lot until the Supreme Court ruled last June. So they were way, way behind in issuing the regulations. And for those 3 or 4 people in the Western world that actually read this law, they know that it requires an awful lot of regulations in order to clarify it. Now, basically what the Department of Labor and the IRS have done is they have issued several temporary regulations. Notice the word temporary. Basically what they are saying is you can use these regulations now, but they are not finalized. A tremendous number of people have written to the IRS and the DOL regarding these regulations about possible changes and so on. We expect to see that some more permanent guidance coming down in the next 60 to 90 days. When that happens, we will try and update everybody what it is. But for the time being, we are living with what we have, and we think with what we have in the temporary regulations, that's what's going to be effective for whatever we have to do in 2013 and 2014. Now, you've heard the term pay or play, and I just want to very quickly explain what that means. Pay means that you're going to pay a penalty. Notice the word penalty. Remember that word penalty. We're going to talk about it along more. When you think about what the Supreme Court said, the Supreme Court used the word tax. When the Supreme Court used the word tax, they were talking about the individual mandate, not that which businesses have to pay, that which individuals pay. Second thing is play, and play basically says that you're going to provide insurance for your employees, and we're going to talk about who has to provide it and what kind of insurance they have to provide. Now, first concept is that the insurance that you provide to your employees, if you are a large employer, and we'll talk about what a large employer is in a few minutes, is that the employee cannot pay more than 9.5% of their household income for single coverage, for their coverage. So basically, how do you determine what 9.5% of an employee's household income is? The answer is you can't. You can't go to that employee and say to employees, show me your tax return. They're not going to do it. They don't have to do it. It is a clear violation of their rights. So what the IRS has done is the IRS came in and said, yes, we understand that the rule is 9.5% of household income. However, you don't have to use household income. You can use that employee's W-2 income. Now, the obvious issue for that is that for the vast majority of people, that W-2 income is going to be less than their household income. It's going to exclude the amount their spouse owns, their interest, dividends, capital gains, et cetera, et cetera, et cetera, is not going to be included in their W-2 income. So that means that the amount that the employee is actually going to have to contribute is going to be a little bit less. So let's see what that amounts to. So let's suppose we have an employee that makes $10 an hour, and I'm going to use numbers that are easy for me to calculate because I don't want to use a calculator because I'm lazy. So if I have somebody that makes $10 an hour and works 2,000 hours a year, that means that they can only pay for their single coverage 9.5% of that, or $1,900. So if the single coverage is $6,000, that means they're going to pay $1,900 and the employer is going to pay $4,100. Now, what's important to recognize is that 9.5% applies to their single coverage, not for their family coverage. So that if, again, let's make our numbers easy. Let's suppose that the family coverage is $20,000. That means they still only have to, the employee, are going to have to pay everything for that except the $4,100 that was there for the single coverage. So the employee is going to have to pay over $15,000 for that coverage in order to have family coverage. So that's one of the things that is in there as far as the definition of affordability. All right, and that's very important. Now let me see if I can read this comment. Hang on. What is the estimated cost increase for a typical 50-employer company? Is 9.5% the lowest paid employee? All right, so 9.5% is the lowest paid employee, and we have some significant amounts as far as discrimination goes that you can and cannot do. What is the amount of increase of the typical company? I don't know what a typical company is. The insurance varies drastically from region to region, company to company, experience to experience. I've seen all kinds of things. There was an article that came out yesterday, I think it was in Fortune, that said in some states you're going to see drastic increases in the coverage, and in some states you're going to see some small decreases. We don't know what it's going to be, and one of the other questions is going to be, and we're going to talk about the level of insurance that has to be provided. It's going to depend upon the level of insurance that you provide, which is going to be very different. Okay. So the other question is the 9.5%? Yes, you cannot discriminate as far as the 9.5% is concerned. Oops, let me go back here. We have another new term. Some of us in Massachusetts, if you're in Massachusetts, you're familiar with the fact that Massachusetts has a concept of minimal coverage, which means in order to have your insurance count, you have to have minimal coverage that your insurance has to qualify for. The federal follows that concept. However, they do it a little bit differently. What happens in this case, and again, please understand that I am not an actuary. I am not an insurance all-knowing person. But basically what we now have is we have a situation where in order for the insurance to qualify for your coverage for your employees, it has to have minimal essential coverage. And I'll answer the question about what happens in Massachusetts in a minute. We have to have minimal essential coverage. And what that means is that the coverage has to cover a minimum of 60% of somebody's medical costs. Now, those of you that have really good insurance, like Gray does for its employees, we cover significantly more than 60% of the medical coverage. So that what's going to happen here is some people, some businesses are going to elect to have coverage, and that coverage is going to be less than the coverage that they might otherwise have, full coverage. I was talking to an acquaintance of mine who is the former president of one of the largest Massachusetts healthcare companies, and he said actually he expects there to be a new business that's going to spring up. So that basically if you only have covered for 60% of your medical costs, you're going to have a problem. So that what he expects to happen is there's going to be a supplemental medical coverage similar to what you see with regard to Medicare. So that in Medicare, all right, when you're older like I'm getting to be, all right, we have supplemental coverage that we buy to cover the additional amount of Medicare. And he expects that type of issue to also arise in this situation. Now, somebody just asked, for Massachusetts, do we apply both the federal and the Massachusetts healthcare law? We're going to cover that at the end, but because the question was asked here, the answer is yes. The 5 states, and there are 5 states that already have mandatory coverage for their employees, and basically we in Massachusetts and the other 4 states are going to wind up getting whipsawed because we're going to be in a situation where we're going to have to comply with both the federal law and the state law. And those of you in Massachusetts that think you have a a difficult road to hoe. Someday, if you really want to see coverage that is truly substantial, take a look at the Hawaii law. Now, people thought that they could get around all of these rules by using related parties, and the answer is you can't. Related parties is a very technical term. It's a control group term. And basically, for those of you that understand ERISA, and I'm not going to try and explain what ERISA is, but basically, if you're in a control group, if you own multiple companies, if you control multiple companies, you're not going to be able to get around what we're calling the large businesses or any other businesses by breaking your business down into smaller parts. Related parties don't work. The law specifically says and specifically explains how related parties are going to work so that you have to bring them all together. What we will talk about in a few minutes is there are a couple of small things that you can do with regard to discriminating slightly with regard to related parties. All right. Now, one of the things that is really interesting is if an employee is provided with affordable minimal essential coverage, then they're not eligible for the premium assistance credit from the government. Now, there was a really interesting article yesterday in Forbes. I believe it was Forbes. And basically, the IRS has issued in draft form the form that is going to have to be filled out in order for someone to receive premium assistance. And I couldn't get through the entire form. It's 60 pages long. And the caption in the article was how difficult it's going to be, and you're actually going to need somebody to help you fill out this form. But what's important to recognize here is if you're providing affordable minimum insurance, your employee is not going to be eligible for that premium assistance. In some situations, and this is something that you're going to have to figure out and you're going to have to do a lot of pencil pushing, your employees may actually be better off getting the premium assistance as if they're low-income employees than they are getting insurance from you and only contributing 9.5%. I'm not recommending you do that or anything else. It just gets very, very complicated as to what's going to be happening as to what is actually best for the employee. Beginning for months, and understand that when we talk about the penalty is calculated monthly. The amount of administrative work that has to be done here is absolutely devastating. Just a minute. Okay. For months beginning after 2003, ACA generally imposes an assessable payment on any applicable large employer, and we're going to talk about that large employer, if any one or more of its employees is certified to the employer as having received premium assistance. So basically, we're going to see that anyone and everyone is going to be subject to additional situations. Now comes the key. Are you or are you not a large employer? And now starts the really complicated calculations. An employer is not treated as employing more than 50 full-time employees if the employer's workforce exceeds 50 full-time employees for 120 days or fewer during the calendar year, and the employees causing the workforce are seasonal workers. We in Massachusetts understand the concept of seasonal and part-time workers. Now understand that a large employer, and we're going to talk about how the 50 full-time employees is calculated in a minute, we understand the concept of seasonal employees because we have it. What's interesting in this situation is that to some degree the government has whiffed on this. The government says a seasonal worker is a worker who performs labor or services on a seasonal basis. That makes sense. As defined by the Secretary of Labor, who hasn't defined it yet, including retail workers employed exclusively during the holiday season and workers whose employment is ordinarily the kind exclusively performed at certain seasons of the year and which is, by its nature, not continuous or carried on throughout the year. That makes sense. However, it then goes on and says, through at least 2014, which means now counting this year and next year, employers are permitted to use a reasonable method that they can determine. So basically what we are seeing is that for at least this year, we can determine a seasonal employee in any reasonable method. And unfortunately, we're in an unfortunate situation, because what's going to happen is that we are going to determine what we think is a reasonable definition of seasonal employee. And as some of you that receive our newsletters and other things know, the Department of Labor is being very aggressive in going out and auditing health insurance and other plans right now. And they're going to start taking a look at how did you define a seasonal employee. And they're going to determine whether or not that definition that we used is going to be reasonable or not. So we have a real situation as to how careful we have to be with seasonal employees, so that people that are working, and for example, if you're up in ski country, up north in New Hampshire, Vermont, or Maine, or you're a fuel oil dealer and you're delivering fuel in December, January, February, maybe not as much in March, and you're sitting here and you have to define how many of these people are seasonal workers, you really have to sit down, and we have to be very careful in doing that. And I strongly recommend that you work with an employment attorney or an accountant who understands all of this in determining who is a seasonal employee for this purpose, in order to avoid being treated as a large employer if you're on that cusp. Now, long ago, when I was a young man, a full-time employee was somebody that worked 40 hours a week. Gradually, we now have a definition of full-time employees as somebody that works kind of 9 to 5, 35 hours a week. However, Obamacare, or ACA, now gives us a new definition of full-time. For this purpose, in order to determine whether or not you are a full-time employee, the definition is that you average 30 hours a week, or at least 130 hours a month. So we now have a situation where, contrary to what we have for other types of benefits and other things, we now have a new definition of full-time employee for determining whether or not we reach the 50 full-time employee limits. So how do we count? All right. We count by saying each employee, all right, with an average of 30 hours or more counts as one. So you take all of your employees, see who works in, and we'll talk about how we get to the average of 30 or more in a minute. How it works an average of 30 hours or more, we take all of them and put them in a bucket, and each of them counts as one. We now take all of the rest of our employees who work less than 30 hours a week, add all their hours together for the week, divide by 30, come up with a number, add that to the other people that are full-time, and if that totals 50 or more, we now have 50 full-time equivalent employees, and we are considered a large employer. Now, if you think that's complicated, it is. If you think that's going to require a lot of administrative work, it is. This is going to require an awful lot of administrative work for an awful lot of people, especially those people that are on the cusp of being close to or just over or just under the 50 full-time employee equivalents. An employer that offers its full-time employees the opportunity to enroll in a full-time in an affordable minimum essential coverage that provides at least minimal value is not subject to an assessable payment. So what that says is if you are paying at least 9.5% of the lowest full-time employees' pay, all right, which again, think back what we're talking about here. Go back to somebody that's making $10 an hour, and yes, I know $10 an hour is more than minimum wage, but it's easy for me to multiply it. They're making $10 an hour, and they're working 2,000 hours, so that they're about $20,000 at 9.5%. The most that they can pay in for their single coverage is going to be $1,900, and you're going to have to pay the rest of that. That's what this is talking about. So that basically what we're talking about here is a very, very significant amount that people are going to have to pay that were not previously providing health insurance. For those of you in Massachusetts and other states, this is an entirely different methodology from what you're used to. Yes, I understand that. Yes, it's a pain in the neck, and it's entirely different. We'll talk about a couple of the other states in a minute. However, let's suppose you decide that you don't want to pay for health insurance, that you're not going to pay for it, you're going to go with the penalty. So there's some good news here. The good news here, which is different from the other states, is that the first 30 full-time employees are free. So what does that mean? Let's suppose that when you actually did your calculation and you determined that you have 50 full-time employees. All right, now remember, I'm not now talking about full-time equivalent employees. I'm talking about employees that work 30 hours or more or 130 hours a month. Those are your full-time employees. The part-time employees that we added are just to determine whether or not you're a large employer and you get into this category at all. But let's assume I have 50 full-time employees. Out of those 50 full-time employees, the first 30 employees I don't have to pay any penalty on. So if I have 50 full-time employees minus the 30 full-time employees, the penalty is $2,000 a year. It's paid monthly. But the math is easier when we do this across the year. So let's sit here and say I have now 50 minus 30, which is 20. I have 20 full-time employees times $2,000. My penalty is $40,000. Let me see if I can read this question here. What about employees that are eligible for Medicaid? Do they count into the calculation? And the answer is yes. All right. Unlike other places where, for example, in Massachusetts, we have the HERD form that says you're covered and everything else, none of that applies in this situation. This is a much, much different calculation. So, the interesting question whether somebody qualifies for Medicaid, it wouldn't help to say that they're there. If they're full-time employees, then you have to count them. There is no way of getting around that, unlike the way things are, for example, in Massachusetts. I bring up the $3,000. I don't want to spend a lot of time on it. It just gets even more complicated. The reason I don't talk about it is what's important here is that the maximum penalty that you can have is based on the $2,000. So I've been throwing the $3,000 penalty out because in my calculation, the calculation that I care about is what is my maximum exposure. So I go back to my example where in my example I just gave you, the maximum exposure is that $40,000, and that's really all I'm really cared about is what is my maximum penalty exposure. Now, remember long ago I said to you that this is important. This is a penalty. It is not a tax. It is a penalty on the business. As some of you unfortunately know, penalties are not tax deductible. So that when you're sitting here and you're sharpening your pencil, or you're having your accountant or controller or insurance broker or whoever is going to help you with this, figure out if you're going to do this based upon economics, which way it pays better, whether you pay for the insurance or you pay the penalty. You have to remember that you have to take the penalty and say, I am not getting a tax deduction for that, and increase that penalty for the lack of tax deduction. That's the way this stands. Now, some of you are going to sit here and say, now wait a minute. It is deductible for Massachusetts purposes. It is deductible for Vermont purposes. That's true. It is not deductible for federal tax purposes. That's just another one of the myriad of differences between the federal and the states. We now come to another new concept, and this is a really important concept, and this is why I feel it's important that we talk about this now. There's a new concept, and the concept is called a standard measurement period for determining employee status. And what this allows you to do is this allows you to look backwards, so that basically what you can do is you can say, I'm going to look at least 3 months, 3 consecutive months, but not more than 12 months in 2013. And I'm going to take that period of time, and during that period of time, I'm going to assess each of my employees and see whether or not they average 30 hours a week. And if they did average 30 hours a week or more, or 130 hours during the month, they are considered to be full-time employees. If they did not do it during that period of time, they are not considered full-time employees. And, you know, basically this is just another thing that you have to do, and this is something you really have to look at, and we're going to talk about why choosing this date is more important. But this is something you have to think of now, because we're talking about being able to look backwards here. We're talking about for 2014 being able to assess these employees based upon 2013's employment records. If the employer determines an employee averaged at least 30 hours a week during the standard measurement period, then the employer treats the employee as a full-time employee during the subsequent stability period, which we'll define in a few minutes, regardless of the employee's number of hours of service during the employee's stability period, as long as they remain an employee. Now this, when you stop and think about it, would appear on its face not to make any sense. So basically what we have is we have an employee who during our measurement period in 2013 averaged more than 30 hours a week, or 130 hours a month during our standard measurement period. Therefore, they are considered a full-time employee. They are now going to be considered a full-time employee as long as they continue as an employee during the stability period in 2014. Even if their hours drop, say, from 35 hours a week to 10 hours a week during that stability period, they are still going to be considered full-time employees. And once again, this again is very, very different from what we see in most of the states. So this brings up the importance of now of a stability period. And you notice I have my little teeter-totter here. Stability period is a very important period of time to think about. Unlike the measurement period, which can be anything from 3 months to 12 months, the stability period must be at least 6 months and no less than the measurement period. So, for example, if you chose a measurement period of 9 months, then the stability period is going to be 9 months. So basically, when we're sitting here, the calculation of this just keeps getting more and more complicated. But what's important to remember is that our measurement period is a 2013 period that you have to think about. So basically what I'm telling people, and the reason that we're doing this now, is you have to start thinking about what you want to do for a stability period now, and you have to start doing all of those calculations and measurements right now in order to determine this. Now, what if you hire somebody, all right, and you know they're not going to be a full-time employee? We have a new concept for them, and it's called a variable hour employee. And this is a person that hours vary based upon the facts and circumstances. This is somebody that sometimes can be in there and is taking the position of a full-time employee when that full-time employee is on vacation, and sometimes they're there for less. So basically what we're talking about is a variable employee is somebody that you don't reasonably expect to always work 30 hours a week, but you're going to have to calculate that every single week to determine whether or not this person works or not based upon the standard measurement period. This just adds to more and more difficulty. Let me see what this question is. Unfortunately, one of the things I don't like about this system is it doesn't provide much room for the question. Does any part of the law affect 2013, or does this Armageddon begin in 2014? Armageddon, which is do I have to pay for the insurance or do I pay the penalty, starts in 2014. The Armageddon for this year is determining the standard measurement period, all right, in order to determine what you're going to do. And the other thing that you have to remember is that if you're going to start paying for insurance in 2014, you're going to have to start talking to your insurance brokers or insurance carriers during 2013 in order to determine what level of insurance or where do you want to fall in all the different types of health insurance that are going to be available out there. But, you know, the real cash crunch of pay the insurance or pay the penalty does indeed start in 2014. I do a lot of reading all the time, and one of the things that I read recently is something that's in the Kiplinger letters, and basically what there was in there is there was a redacted, which means all the names were changed to protect the guilty, a form that the Department of Labor had sent out to a business asking them about their health care audits. And this was just a precursor to what they're going to be doing with regard to what happens with their audits of Obamacare. Now, what really was staggering to me is this was a 6-page letter with massive, massive amounts of information that had to be gathered. Now, I'm a tax guy. All right, I'm not an HR guy. So I kind of gave the letter to our HR professional and said, "How much work is this?" And she read it and just was aghast at the amount of information that's being asked for and the amazing amount of time that is going to be asked for. Basically, you can get it. There's a reference on the Kiplinger reference down the bottom. It's also available on our website, easily available. If you want, you can email me, and I'll email it to you also. It's just staggering the amount of information that the Department of Labor is asking for, and they've already indicated that they're going to be asking for even more information when Obamacare kicks in 2014, and they've indicated that they are aggressively going to be auditing people. There are 5 states with required health insurance today. Massachusetts is one of them, Vermont is one of them, and Hawaii is one of them. I always keep meaning to look up who the other 2 are, and I just never get around to it. The good news, as I previously mentioned, the good news is that those of us that already have required health insurance, we have some concept of it. The bad news is the rules are entirely different. Contrary to what the people were saying, that Obamacare is based upon Romney care or whatever you want to call what we have in Massachusetts. There are very, very substantial differences between what we have in PPACA/Obamacare and what we have in Massachusetts. It's very different from Vermont and very, very different from Hawaii, which are the three that I know of. So that basically you can be sitting here and you can qualify under federal and get penalized in the state, or vice versa, or you could get penalized by both the federal and the state. So this is for those states. It's really, really not a good deal. Hang on. Wait, let me see if I can. Okay, so the question is, what if there is a conflict regulation between federal law and state law? We both lose healthcare law. Which one takes precedent? Neither one takes precedent. I mean, this is the amazing part of this, and I've spoken to a bunch of people both in the state and down in Washington. Neither one takes precedence. You would think that one law would supersede the other. That is not the case. Both laws are there. You can have qualify for one and not in the other. I understand that doesn't make sense. I understand that this now requires even more work. What we have to do as far as record keeping in Massachusetts is substantial, as it is in Vermont and as it is in Hawaii, the three that I know. What you're going to have to do for record keeping for Obamacare is also substantial, and they're not the same. It is absolutely going to be an administrative nightmare in those 5 states. I want to talk about one more thing that I've been talking about, and the reason that is important, and what worker classification means is, do you treat a worker as an employee or as an independent contractor? The reason this is important, all right, is obviously as an employee, the person qualifies for benefits such as health insurance, retirement, workers' compensation, et cetera, et cetera, et cetera. As an independent contractor, they qualify for none of that. The IRS has indicated, and the Department of Labor has indicated, they are going to be extremely aggressive in going out and auditing businesses specifically to determine worker classification. And they're going to be doing that because of Obamacare. In other words, all of a sudden what we're talking about is that if someone is an employee, they're entitled to health insurance. If they're an independent contractor, they are not entitled to health insurance if they work. There are some articles that are out there. There's some very, very good articles that are out there with regard to who is a worker, who isn't, who is an employee, who isn't. It's not always clear. The one thing that I will say is that if you have people and you think that you are classifying them as independent contractors and they really should be your employee, one of the things you may want to consider is that the IRS currently has what I call a limited amnesty period that runs through the end of June, where you can significantly reduce the amount of penalties that you would otherwise be subject to. It is a difficult determination. I suggest you pick up the phone, call me, call a labor lawyer, call somebody else that understands this. This is a big, big deal. The IRS is going to be looking at this very, very closely. The other thing you have to understand is that if this worker is an independent contractor and they go to the exchange, for example, we call it the connector here in Massachusetts, and they go and they say, all right, I want to get a reduction. I want part of this paid for by the government. One of the things that they're going to ask for specifically in this 60-page questionnaire is, where do you work? How many hours do you work there? Right. And that is going to lead directly to questions of worker classification. So that you really, if this is an issue, you really want to take the time and think about going and talking about it now. It is complicated. um, give me a call, give a labor lawyer a call, talk to HR specialists. It is a very, very complicated situation. I think I missed a page. We obviously have outstanding newsletters that are available. If you would like them, you can get them. Just go to our webpage, and down in the lower right-hand corner, you can look up any newsletters that are out there, and some of them have some really great articles that are written by people here at our firm, or you can join and request any number of the various newsletters that we put out. They're outstanding. I suggest that you pay attention to them. Also, we're available on Facebook and Google Plus and Twitter and all of the other social media if you want to join in that area, if you're into social media. There's my ugly picture again. If there are any other questions, please type them in now. Feel free to give me a call. I will be around for a little while today. I'll be around tomorrow morning. You can email me. Like I said, I'm going to be away. Tina and I are going away next week. But after that, you can give me a call here in the office, or you can email me and I'll get back to you. I strongly, strongly urge everyone to really sit down and figure out what is best for you and your employees. It is an extraordinarily complicated situation for those people that are large businesses that have more than the 50 situation. Some large businesses are able to buy their insurance from the exchanges if you have up to 100 employees and so on. We didn't really want to get into that. That gets too complicated. But you really have to sit down. You really have to get your insurance people in, make them explain to you what insurance is available, what levels of insurance is available, the different costs, if they can determine them now, that are going to be available, and so on. This is a very complicated situation. So if you have any other questions, wait a minute. Hang on. Will Deval Patrick repeal the Massachusetts health care law? I believe he submitted a proposal to do so. The answer is Deval Patrick, Governor Patrick, has issued a proposal to the general court, to our legislature, to modify our legislation. There is a great deal of discussion going on with that, and one of the reasons why the discussion is happening in that area, based upon the people that I've spoken to, is that the Massachusetts law forces small businesses that are smaller to provide insurance than the federal law does. And a lot of people are sitting here and saying, well, do we want to let all of those mid-sized businesses off the hook? And Governor Patrick, I think, put that legislation in 6 or 8 weeks ago. I know that there is discussion about it. If anything does happen with that, we're keeping track of it, and we'll let you know. I never try and guess what's going to happen with politicians. Every time I guess, I'm wrong. But we will be following that to see what happens, whether or not the Massachusetts and some of the other states go and do the same thing as the federal law, or whether they keep their own. All right, are there any other questions? Okay, if not, I want to thank all of you for attending. Once again, if you have any questions, you feel free to give me a call in the office, or email me, and I will do whatever I can. I strongly suggest that you make sure you find somebody that can really help you through this maze of a situation. As more things become available and as things become clearer, we'll make sure we let you know about it. So thank you very much.